We're seeing some mixed major averages here. The Dow down by about 0.5%, S&P 500 and the Nasdaq, though, holding on to gains. All of this activity coming following Trump's proposed tariff plans. Joining me now, we've got Keith Buchanan, good friend of the show, GLOBALT Investments Senior Portfolio Manager. Great to have you back here with us, Keith. You say you're leaning out of tech and into financials. Tell us why.
Well, thanks again for having me, Brad. We've been looking at growth as a source of funds for some months now. As it grew as a much larger component of major indices, we saw sentiment reach to extremes in a way that we just haven't seen in the past from a valuation differential between growth and value. A lot of that was largely the AI trade, kind of tech-oriented. So we've been moving to a more balanced approach here over the last couple of months. Not necessarily, selling or going, short tech in any possible way, but we do look at the potential for our economy to continue to grow, even beyond, historical trends. Tends to benefit value stocks in a way that just weren't reflected in the valuations. And our opportunity, we felt like presented itself for us to become more balanced.
And so when you talk about looking at financials right now and really having a preference, do you have a preference for some of the biggest banks out there, or is it towards some of the regionals?
We absolutely have a preference towards some of the larger money center banks. We have positions in Bank of America, JP Morgan, Citigroup, just to name a few. As the yield curve continues to, I think after yesterday, we still say that the trend is for the yield curve to continue to steepen. If growth rates continue above trend 2 to 3%, inflation continues to come in to a soft landing scenario. All that benefits the financials in a way that we can see loan growth and profitability improve, as well as economic activity and transactions continue to accelerate. All that benefits the larger money center banks in a way. And the regional ones, we don't necessarily want to shy away from those. Those stand to benefit as well, but in a more concentrated way. And I think that's a little more geographically opportunistic rather than just making a play on global, macroeconomic trends, as I mentioned, for money center banks. But we're very positive on that group. And we've also started to spread some of our exposure elsewhere in financials as well.
If we were to see loan growth to the level that hits your projections, what does that spell out to you about the state of the consumer?
That's really interesting. We're actually thinking about that very carefully right now. The consumer is well employed, no doubt. That started to soften on the margin as bringing up some concern, as we've seen credit card delinquencies start to tick higher, not necessarily causing a lot of trouble at the banks per se. But we are taking note of what that means for the consumer. We've seen with some of the earnings rhetoric around Walmart and Target, how those almost seem like they're moving in opposite directions from an inventory and demand standpoint, as well as the consumers that are coming into Walmart. They've talked about more affluent consumers coming through and making larger baskets. And that's not necessarily anything that aligns with a reacceleration of economic growth. And the reacceleration of economic growth historically doesn't happen without the consumer participating, if not leading that reacceleration. So we're really careful about what the consumer is showing in their activity, even if that differs from their sentiment.
As you mentioned Walmart, naturally, I'd love to get your reaction to what you think of the results that we've seen from retailers over this point of the earnings season.
Sure. We're really impressed with what Walmart has been able to accomplish coming into the pandemic, out of the pandemic, when there's more preference for goods over services. And as that's shifted to services away from goods, they've been able to continue to grow and evolve around the current economic winds in a way that many retailers, frankly, just haven't been able to get as good a control as Walmart has been. Target has its challenges from an inventory standpoint that we saw a couple of years ago, and they're starting to reemerge, perhaps, in our view at least. But the consumer is always different. Every environment, no two environments are the same. And we've seen Dick's Sporting Goods, for instance, that reported this morning, look totally different from a Burlington or a Kohl's or even a Best Buy, if you will. So the consumer is evolving. Sporting goods seem to always be in vogue. And apparel and footwear seem to be a little more challenging as far as how to position the shelves where consumers' tastes currently lie. And we've seen challenges around that. Walmart is in our opinion, a logistical stalwart that can move things around and have warehouse space in every nook and cranny of the U.S. economy. So it can be a little more aggressive as far as how it positions itself. And that's been paid dividends over the past couple of years.
Keith, just lastly, while we have you here, what is perhaps one major outlier as you're looking at it through your lens for 2025 that you think investors would be apt to consider how it might benefit their portfolio?
We've been looking a lot more, again, to the original point of where can we find opportunities for earnings growth is not captured in valuations. And where we're seeing a lot more of those opportunities aligned is in the quote unquote traditional, more value spaces. And we've seen that performance start to pick up. But we also have an equity income strategy that's seeing value names that have a dividend income stream that's reliable and growing to also benefit as well. We see free cash flow as a factor that's really driving a lot of equity returns in a way that it hasn't in the past. And that can benefit a lot of companies that just don't get the valuation that they perhaps deserve over the past couple of years, given the macroeconomic environment.
Keith Buchanan, who is the GLOBALT Investments Senior Portfolio Manager. Keith, good to see you. Thanks so much for taking some time here with us today.
Thank you, Brad.